We've got one company today, 469A, freshly listed on the TSE growth market and already swinging for the fences on M&A.
Yeah, this one's a classic post-IPO story. Raise money, spend money, worry about profits later.
So, this company, Personal Training Gyms, listed on the growth market in December 2025, raised about 223 million yen. Walk us through what happened next.
Well, they immediately went shopping. May 1st, they acquired 4 Pilates brands and 11 studios from Ascenders Corporation for 325 million yen. That generated 248 million in goodwill. So nearly all of the purchase price is intangible.
That's a lot of goodwill relative to the deal size. And then they signed another agreement in July?
Right. A basic agreement with Valix Inc. to acquire their 24-hour gym business and form a capital alliance. So they're pushing beyond personal training into both Pilates and round-the-clock gyms.
Diversification or desperation? Because the financials don't look great. Revenue grew almost 14% to 1.54 billion yen, but they swung to an operating loss of 12.6 million.
Exactly. Advertising expense jumped 47 million yen alone, plus personnel and store operating costs from all the new openings. Add 9 million in IPO expenses, and a spike in doubtful account allowances, and ordinary loss hit 22 million. Net income collapsed to under 8 million from 100 million prior year.
So they're literally burning the IPO proceeds on growth investments and acquisitions before the business model proves it can scale profitably. No dividends, obviously.
None. And cash flow tells the story. Investing outflow of 300 million, financing inflow of 476 million. They also took on 150 million short-term and 200 million long-term debt on top of the IPO money.
So they've got leverage and goodwill and no operating profit. The brand integration of the undue superbody labels? Is that a sign they're getting disciplined?
Maybe, but it's early. They're consolidating 2 personal training brands while simultaneously launching into Pilates and 24-hour gyms. That's a lot of plates spinning for a company that just went public 6 months ago.
The preferred share cleanup and capital reduction are just post-IPO housekeeping. Nothing to read into there. The real question is whether this M&A spree creates recurring revenue or just recurring losses.
Watch for the Valix deal closing and whether the Pilates studios contribute meaningfully to revenue next quarter.
And whether they can slow the ad spend burn. Thanks for listening.